Good morning, ladies and gentlemen, and welcome to the 113th Annual General Meeting of Witan Investment Trust plc. My name is Andrew Ross, and I'm Chairman of the Board. I'm pleased to confirm this meeting is quorate, and we can now proceed to business. We made the decision to hold this year's meeting in a virtual format, given the circumstances surrounding COVID-19 and the rules and guidance relating to social distancing and shareholder meetings. I'm sorry this means that we cannot meet and talk to you as usual, but I hope you will find the online meeting an acceptable alternative. I will now hand over to Andrew for his presentation.
Good morning, and as the Chairman said, welcome to Witan's 113th Annual General Meeting. I would like to give a brief summary of our results for 2020, the main changes we made to the portfolio, and some thoughts on the current investment outlook, accompanied by slides which will appear on the screen. First of all, the 2020 results.
Despite the pandemic, to many people's surprise, global equity markets delivered a positive return in 2020, with the UK being a notable exception. Our revised benchmark index rose 9.5%, 3% higher than the benchmark it replaced. However, Witan underperformed with an NAV total return of 4.2%. The share price total return was 2.7%, owing to Witan's shares ending 2020 on a wider discount than at the end of 2019. Our dividend per share was increased by 1.9% to 5.45 pence, drawing on our retained revenue reserves from previous years. Despite lagging our benchmark, we finished 2020 with a record net asset value, share price, and dividend per share. Looking at performance in more detail, as the chart shows, the first quarter did the damage, with the measures to control the COVID-19 pandemic inducing a recession and an extremely sharp fall in global stock markets. The green line shows Witan's portfolio return, which fell steeply during February and March, before recovering the lost ground to show a gain of 4.2% by the end of the year. The blue line shows the performance relative to our benchmark. We sharply underperformed during the market sell-off, performed similarly to the benchmark in the initial recovery, and in the second half of the year, our restructured portfolio outperformed significantly. In the end, we finished the year up 4%, but 5% behind our benchmark. There were four principal reasons. The foremost reason for this below-par performance was that our portfolio started 2020 positioned for the moderate economic growth expected at the time. This portfolio had performed well in late 2019 as hopes for growth became more positive and political uncertainty in the UK dissipated following the general election. In contrast, the pandemic control measures precipitated a global recession and a sudden drop in the equity markets. We were clearly wrong-footed, but as with bungee jumping, it was too late to change our minds mid-plunge. The worst hit sectors, such as financials and other economically sensitive companies, were those our managers had chosen, expecting a decent year for economies. Following the market chaos, we continued with our portfolio restructuring, and our managers took advantage of opportunities to reassess and reorientate their portfolios for the changed outlook. Secondly, we were underrepresented in the technology and internet-related stocks whose prospects were boosted by the demands of home-based working, shopping, and leisure activities. Our managers had previously reduced exposure to these stocks on grounds of valuation and regulatory risk. However, these considerations were rendered irrelevant in 2020 as recurrent lockdowns accelerated the growth of the digital economy at the same time as crushing the performance of other parts of the market. Thirdly, the effects of this shift in sector fortunes were intensified by our adopting a revised benchmark with double the weighting in the US and a corresponding reduction in the allocation to other regions, mainly the UK and Europe. For valuation reasons, we chose to implement the portfolio transformation gradually, which in retrospect was wrong and proved costly to performance in the early part of the year due to the US market's greater exposure to technology stocks. As part of the changes reflecting our more global benchmark, we conducted an extensive search for specialist growth investors, appointing the New York-based Jennison Associates and California-based WCM Investment Management in August. Finally, gearing was costly to performance in Q1 as we were invested for a positive market environment. We acted to reduce gearing during the period of maximum uncertainty and repaid some relatively high-cost debt to lower our interest costs and increase investment flexibility. Gearing contributed positively from March onwards, but was a headwind for the year as a whole. Staying with gearing, over the long term, the selective use of gearing has enhanced returns for Witan's shareholders. The blue bars show that in 7 of the last 10 years, gearing has boosted returns. 2 of the exceptions, 2011 and 2018, were years of falling markets when gearing is a disadvantage. The third occasion was last year, when the early volatility cost more than we were able to recoup during the subsequent rebound. The pink line shows Witan's reducing burden from borrowing costs. This is an important trend because the average interest rate on our borrowings is down from over 7% a decade ago to under 3% now, which reduces the rate of return required for borrowings to improve shareholder returns. Turning to good governance and ESG more broadly, sustainability in investment has attracted greater attention in recent years, but seeking to invest in honestly managed companies with a long-term future providing useful goods and services is nothing new. Evolving best practice in this area is set out in the UN's Principles for Responsible Investment, to which Witan became a signatory in February 2020 and to which all our managers are also signatories. Both they and we have further formalised the process of engaging with investee companies to encourage improvements, for example concerning climate change, and hold them to account when they fall short. This is the foundation for delivering good returns for shareholders, as well as a better future for the planet and its people. Moving on to the dividend, as noted earlier, we lifted our payout by 1.9% in 2020 to 5.45 pence per share. This was ahead of the inflation rate of 0.6% and marked a 46th consecutive year of dividend increases. Over the past 10 years, Witan's dividend has risen by 9.6% a year. However, 2020 was a reminder that the past should not be extrapolated into the future, as the pandemic caused an unprecedented range of companies to cut their dividends due to pressure on earnings or as a precautionary measure, in some instances under pressure from financial regulators. We were able to raise our dividend despite this by making use of 19 million of Witan's 71 million of retained revenue reserves from earlier years. Although the company is a total return investor, the board also recognises the importance of a reliable and growing income for many shareholders. The company's policy remains to grow the dividend ahead of inflation, and the board intends to continue to use revenue reserves to support dividend growth, alongside rebuilding dividend cover from annual revenue earnings. Turning now to the discount. The chart shows that Witan's discount has narrowed from a prevailing level of over 10% a decade ago to a range of 0 to 5% for most of the time since 2014. Last year, Witan's discount widened from under 1% at the end of 2019 to over 7% for much of 2020, ending the year at 2.4%. This was for a range of reasons. Investor sentiment towards equities was negatively affected by the recurring lockdowns and economic uncertainty. Despite Witan's performance recovery, some investors may have hesitated to buy in the wake of weak performance at the start of the pandemic. There are also indications from widening in other trusts' discounts that some institutional holders are reducing their holdings of investment companies in favour of investing in equity markets directly. The company's response, as well as the portfolio restructuring discussed earlier, was to step up the pace of share buybacks, purchasing over 7% of the shares into Treasury during the year. Buying our shares at a material discount is accretive to the net asset value. and by reducing surplus supply in the market, it contributes over time to a narrowing in the discount. Our longer-term aim remains to achieve a sustainable low discount or a premium for Witan shares, and our actions in the market are a sign of the board's commitment to this end. Finally, we look at the shape of the portfolio following the changes in 2020 and set out our expectations for the investment environment in 2021 and beyond. This slide shows the managers in place at the end of the year. Just under 3/4 of the portfolio was accounted for by designated core managers, 5 being global stock pickers and 1 a UK equity manager. The remaining quarter is more specialised. At the year end, it was shared between 2 regional managers covering Asian and emerging markets, 2 small global portfolios including a specialist climate change fund, and a portfolio of investment companies mainly invested in the private equity, biotechnology and global mining sectors. The core managers had mixed fortunes during 2020, holding back overall performance, while the specialist categories mostly fulfilled their objective of boosting the relative performance of Witan's overall portfolio. The shape of the portfolio was markedly different at the end of 2020 from the beginning. The underweight position in the US halved during the year, with a corresponding reduction in the UK and European overweights. At the sector level, the main changes were a reduced exposure to industrial companies and increased exposure to commodities and information technology. These changes followed the restructuring of the portfolio to reflect the more global benchmark adopted from the start of 2020. However, the positioning remains distinctly different from the benchmark, owing to our managers' stock decisions. In general, they currently see better relative prospects in non-US markets and from companies set to benefit from economies reopening, rather than from the so-called COVID winners of 2020. The figures for our geographical and sector exposure are updated each month in our fact sheet, along with commentary on current events and performance. Turning to performance so far this year, in the first quarter of 2021, Witan's NAV total return broadly tracked the continued rise in our global benchmark index with month-to-month fluctuations. This is, of course, a very short period and, like all performance figures, must be linked to the caveat that good or bad performance should not be extrapolated into the future. Looking at longer-term performance before the pandemic shock, as well as performance since, we believe the sharp setback a year ago was exceptional and anomalous. It was a one-off response to a historically unique event. The following slide shows performance in the 5 individual years ending with 2020, which we've discussed earlier. Turning finally to the outlook. An important point to note is that 2020 was a year that warns against overconfident forecasting. Nonetheless, the improvements in medical treatment for coronavirus cases and the widespread vaccine rollout together seem set to allow a general reopening of economies after the recurrent lockdowns of the past year. This is occurring against a background of near zero or even negative interest rates, coinciding with massive fiscal stimulus packages implemented in many developed economies, particularly the United States, which remains the world's largest economy. In addition, for many consumers, the restrictions on economic activity have created pent-up demand, while companies are being encouraged to invest by tax incentives and government initiatives linked to mitigating climate change. A period of strong economic growth is therefore in prospect, which could prove prolonged, as governments seem set to allow their economies to run hot rather than tightening policy quickly once recovery is underway. There are, of course, risks. Inflation may re-emerge after a generation of slumber. Valuations are high by historic standards, pandemic concerns have not disappeared, and international relations are sour on several fronts. Nevertheless, overall we think it is right to take a positive view of the opportunities as the world reopens, while remaining watchful and selective. Thank you.
Thank you, Andrew. We're now going to turn to take your questions and thank you very much for those of you who've submitted them in advance. We'll endeavour to answer as many questions as possible, but if there are questions we can't answer immediately or we run out of time, we will respond to all the remaining questions via email to the individuals concerned. Also, in the interests of time, if I get similar questions, I'll group them together into a single question. So I'm now going to attempt to compare this section, and the first question we've got in is, please explain how Witan differs from its rival Alliance Investment Trust. Andrew.
Well, we've obviously had a lot more in common with Alliance Trust since 2017, when they had a bit of a shareholder rebellion and decided to adopt a multi-manager approach instead of managing their assets from an in-house investment management company. So since then, actually, Alliance Trust has done better than Witan over 3 years. We've done better over the past year, and there's room for both of us in this market, I think. They have a slightly different benchmark from us, but the main difference in how we operate is that rather than setting all of our managers, or virtually all of our managers, the same objective to fish in the global pool of equities, we allocate up to around 25% of our assets to a range of specialist categories, whether it be geographical specialists or sector specialists or different asset classes, because we think that gives us an ability to take advantage of opportunities which are off the beaten track and probably wouldn't be picked up by generalist fund managers.
Thanks. Next question. The performance a year ago was poor and compared badly with other generalist trusts. Part of this underperformance was linked to high holdings of value at the expense of technology. Value has outperformed since last autumn. Will the board please confirm that the approach is one of diversification with weightings as conditions determine, with a pragmatic approach rather than a dogmatic approach? Well, I think Andrew's answered the first part of that question in a number of places, not least earlier on this morning. But Andrew, perhaps you could make some comments about the latter part of that question, about pragmatism again, as opposed to dogmatism.
Yes, we aim very much to have an adaptable approach. Overall, we have some managers who are growth specialists, some who are quality investors. We no longer have any exposure to systematic value management because we like to have managers who are able to skew their portfolio according to changed circumstances. The world doesn't stay the same, so it's no use putting all your sail up and hoping for fair weather if the weather turns out to be poor. So we aim to select managers who are adaptable to circumstances and whose fortunes depend upon the individual stocks that they have in their portfolio rather than which part of the style spectrum they lie upon. The problem a year ago was that we had adapted to a world that didn't happen. It was very much a combination of incorrect decisions with the benefit of hindsight and changed circumstances. Happily, our efforts since April 2020 have been more successful, and that's what we're obviously working very hard to sustain.
Okay, the next question is reasonably abrupt. Is the board happy with the performance of the CEO? Well, slightly counterintuitively, before I comment on that, I'm going to ask Andrew himself to make a couple of comments.
The chairman, of course, will speak for the rest of the board, but for my part, of course, I wasn't satisfied with either Witan's or my own performance in the early weeks of the pandemic. Nobody likes to miss out on opportunities or to be caught out by circumstances, and however extenuating the circumstances were, the bottom line is that for shareholders, we got it wrong and had a bit of a shocker in performance terms during February and March last year. We made a number of changes, which we reported on at the time and which were summarized in the presentation a few minutes ago, but we avoided throwing the baby out with the bathwater. You can't navigate using a rear view mirror. Obviously, where over the past 12 months or so, the performance has significantly recovered, and I believe that our restructured portfolio is on track to deliver shareholders through varying conditions. We've seen very different conditions in almost every month of this year, and our portfolio is quite well up year to date, slightly ahead of the benchmark, and that's, I think, indicates that we don't have any enormous tilt towards one part of the market or the other.
So I think the board would clearly share Andrew's disappointment with the investment performance, and clearly, as far as a chief executive is concerned, there is a difference between his performing his role as CEO and the pure investment performance. And I think as far as the role of CEO is concerned, I'd actually, the board would share the opinion of another shareholder who emailed in to say, this is not a question, more a comment to say, well done for keeping your nerve with a bit of gearing even through the height of the pandemic issues a year ago. And I think at the end of the day, Andrew is an extremely experienced investor. We'll happily have a board who are experienced and have been through similar, although definitely not identical, periods before. And as far as Andrew's leadership of the company, his leadership of the people who work for him, and that is not to be underestimated as to how difficult that was, remote working during a crisis and a pandemic. I think Andrew has acquitted himself extremely well. So the board is completely satisfied with his services as Chief Executive Officer. The next question is, what is the future outlook for the company?
Well, the outlook can mean a number of things. I mean, what Witan is for, if you like, is to offer our investors diversified exposure to global equities using a multi-manager approach. We aim to beat our global benchmark total return terms, and within that to deliver a growing income over time to shareholders. So that's what we aim to continue to do. We've over the years changed from a predominantly UK-based portfolio 20 years ago to one that's now around about just under 20% UK, and the rest being exposed to the US and other global markets. So it's very much covers the spectrum of global opportunities, we believe. In terms of the near-term outlook, I think that, as I referred to in the presentation a few minutes ago, the prospect of better treatments for COVID, of the rollout of vaccinations, and the record low level of interest rates, a lot of fiscal initiatives being put into place, the prospect is for a period of really quite rapid economic growth by historic standards. And with that background, we think that there's a good prospect that the performance honours will be shared by a wider range of sectors, whereas everything over the past year or two has disappointed except technology.
Okay, the next question is on is ESG related. It's notable that there are no oil majors in the top 40 investments. Is this ESG or performance driven?
It's primarily driven by the investment choices of our managers, and obviously all our managers are signatories to the UN Principles of Responsible Investment, and one of those is going to, and that entails explicitly weighing up the costs as well as the benefits of for example, contributors to climate change. And so for many years, even before ESG appeared on people's was quite so high profile on people's agenda, we were very underweight in the oil sector, and that was, I suppose, because most of our stock pickers are reluctant to buy a company whose fortunes depend upon the price of a commodity that they have no influence over. They, the managers, and they, the companies, have no influence over the oil price, which determines the performance of the sector. So we as part of our review of our managers, and they, as part of their assessment of investments, have to try and weigh up the prospects for returns against the risks to those returns. Those risks can either be operational, they can be political, regulatory, taxation, and if you like, all of those things are probably weighing on the long-term prospects for the oil sector. We don't impose restrictions on their holding oil stocks. If they felt that despite the risks, those companies were well managed on an improving path of social responsibility and were attractive in investment terms, they could hold them. But at the moment, despite the fact that there probably is some cyclical oomph behind the oil sector over the very short term, at the moment, I think they've decided that there's no shortage of reopening opportunities which perhaps don't have some of the environmental baggage that the oil sector does.
Thank you, Andrew. Next question. Does the manager have any concerns about the use of leverage by investors in the US equity market in the light of events involving the Archagos family office? Was this an isolated event or a sign of a wider underlying problem?
Well, there are multiplying signs of excess in the markets, which doesn't mean that the markets as a whole are riddled with wormholes and about to collapse. What it indicates is that if you supply vast amounts of liquidity at very low costs to markets, some people will invest it unwisely. And we've seen, there was an example recently of a company whose sole asset was a delicatessen somewhere in one of the American cities, and this company was valued in somewhere in the billions of dollars. Well, as somebody commented, the pastrami must have been very good, and there are signs of froth in some parts of the technology sector, perhaps some parts of what is commonly called crypto. The thing that we rely, first of all, we don't allow any of our managers to use leverage. We do use gearing at the corporate level, but we have our finger on that button and we can adapt it. But the managers themselves are not allowed to gear their portfolio or buy geared, if you like, derivatives within their portfolios. And we also try to ensure that the investment process and the investment approach and analysis which our managers apply means that they look for companies of substance. They're effectively looking for companies which have a value which has a predictable growth rate, or which is addressing a potential market at the growth end of the spectrum, which is growing very rapidly, and where the capabilities of the manager or their technology appear to give them a unique insight. So yes, I think one of the risks to portfolios at the moment is that the leverage in the market gets out of control. But we believe that we just don't play in some of the areas where the piranhas are going to strip the flesh from your bones.
The next question is sort of the other side of the coin, I think, to that one, which is, could you kindly provide your thoughts in terms of the numerous metrics that demonstrate that markets are at all-time highs? However, this is at a time when inflation expectations are rising along with bond yields. Should not cheap insurance in the form of a hedge or put options be considered to protect against turbulence? This has been proved highly successful in other trusts such as diverse income.
I think there's always a debate to be had as to how much insurance you want to have within the portfolio against your judgment of the overall prospects for markets. And the starting point for us is that if we felt we needed to have some form of put option insurance, then the signal would be that our gearing would be run down to low levels. At the moment, our gearing is around about 10%, down from 12 or 13 earlier in the year. So we're a little bit, we've been taking a little bit of money off the table as the markets have become more positive. The problem, of course, is that insurance isn't for free. You have to burn up some of the NAV to buy your put option in the hope, I suppose, that money will become worthless and that the rest of the portfolio will perform. But as others have found, when you do get circumstances where the insurance pays off, your house burns down, you have the money to rebuild it. At the moment, our sense is that there are large swathes of the market that are still very modestly rated. There are concentrated pockets of very high expectations. It doesn't mean those companies aren't good companies, but it means that more of the future investment returns is probably already in today's price. So if you adjust for the level of interest rates, even taking account of the interest rates, bond yields have gone up a little bit this year. you're still looking at gilt yields which are in the order of sort of 1 to 1.5%, and for a market that on prospective earnings is probably on 15 times, or an earnings yield of 6 or 7%, that still seems to us to offer value. It's not risk-free value, but our sense at the moment is that we keep these things under review, and going back to the adaptability point at the manager level, we're also adaptable in terms of the level of gearing that we use. So we have an open mind about the use of something like a put option, but at the moment we're happy to be fully invested.
I think also there's a sort of structural point here that, I mean, we're very conscious that Witan forms a part of an investor's portfolio, and it's an equity part, and you're not entirely sure how underlying investors are thinking of you, and on that basis we need to, unless we feel very strongly about it, retain people's exposure to equity markets. I've got one final question that was sent in advance, which I think is the perfect way to wrap up the Q&A, which is, please can you ask merchant tailors to send me some of those delightful cakes to enjoy during the AGM? It would make the virtual meeting a little more realistic. Well, sadly, we were unable to arrange that, but hopefully you've had your own cakes while you listen to us. That concludes the formal business of the meeting, and I now declare the meeting and the poll closed. Thank you all for your attendance, and once again, I'm sorry that we were not able to meet in person this year. I very much hope that the AGM of 2022 will be a more normal affair, and we can welcome as many shareholders as possible to the meeting.